Hi, I'm Pattu from FreeFinCal. Many times I've been asked, I'm an NRI, where should I invest? What are my investment options? And so on. I generally tend to avoid answering these questions, or I ask a financial advisor from my fee only list to answer it. And I have a couple of articles on this. But I've still get asked these questions, and I made a video on this in Tamil yesterday, and I thought I have not talked about it in the English segment, so I thought I'll do one. And this is not a detailed walk through about what an NRI should exactly do and so on, but I'm going to talk to you about the major issues that one should consider, non-resident Indian should consider before they begin to invest. The first question that NRIs make is when they ask other people, they say, "I'm an NRI. Tell me where I should invest." That's wrong, because they should first specify the country they live in, because an NRI living in Singapore will have different tax laws from an NRI living in Europe, or an NRI living in the Middle East, or an NRI from USA or Canada. So the first thing that you should know before you leave to another country is that what are the tax laws there, and in particular, how are instruments that you make in India taxed in your country of residence. That's the only key point. So when you make an investment in your country of residence, that is going to be taxed there, and India will not come into picture there. But when you make an investment in India, then you will have to pay tax in India and also pay tax there. There's something called as double taxation avoidance agreement, but that doesn't mean you can escape fully from tax. So let's take an example for for the simplest situation. The simplest situation is when the country of your residence has no income tax, like many countries in the Middle East. So then it essentially means that any investment that you make in India will have its own specific set of rules. There will be TDS on mutual fund investments, and you and everything else is pretty much normal. Of course, you have access to NRE tax free FDs that you can use to some extent in your debt portfolio, and other than that, everything else is pretty much the same. And you can plan for retirement normally, plan for your children's education normally. Retirement is a little tricky because you may want to do it back in India, so you will have to take into account inflation in India. But children's education, if you want to do it there, then you will have to take into account inflation there and so on. So you'll have to take these considerations into account. These can be done with normal calculators, or you can take help from a SEBI registered investment advisor. But if you get into US, Canada, NRIs, things become extremely complicated there. For example, although they have access to NRE FDs and that's tax free in India, they'll have to pay tax there. They'll have to declare it to the US, Canada governments and pay tax on it. And take mutual funds or stocks, that becomes much more complex, because you will have to declare notional income on these mutual funds or stocks without even if you don't redeem from them every year when you file taxes in your country. And finally, when you actually make a redemption, let's say it's a long term capital gain, and let's say its equity and long term capital gain is 10% here in India, and Canada, USA will have a double taxation avoidance agreement. This means that, suppose, for example, if the long term capital gains tax in USA is 30%, in India it's 10%. What this means is that you pay 10% tax in India, and the remaining 20% you have to pay tax in the USA. That's what actually double taxation avoidance means. But then it's not so simple as that, because you would have already declared the capital gains on those investments every year as notional income. So you'll only have to pay the balance amount as tax in the USA. That is that balance, whatever you have not yet paid, you'll have to pay in the USA. So it's an extraordinarily complex situation. That is the reason why many financial advisors, chartered accountants would recommend that once you go to the US or Canada, you make sure you don't have any investments in India. If you want to have investments in India, do it through your parents or children or siblings or whatever it is, as the case may be, with an Indian resident that you trust, that you can get your money back later on. But then please remember that if you have a parent here and if you're investing through the parent, and if you have siblings, technically you've given it to the parent, so the money is theirs, and after the death of the parent, the siblings can have a share, can ask for a share of that money. So that can, those kind of complications and situations can arise. So you have to be very, very clear about the taxation. I'm not aware of the tax rules in Europe and so on. So you'll have to first find out. And also, you may have a pension plan. Like for example, in the US, you have the Roth IRA things. You can't get out of it even if you come back midterm to India. Then you may want to find, you can get out of it, but there will be some loads and so on. So you'll have to find out whether it's beneficial to leave it on or close it and so on. That's something that you'll have to sit and calculate depending on how many years the account has been open, how many years are there still to your retirement, and so on. So those are complex situations that you will have to, it's better for you to get professional help. That's my sincere suggestion. Or you will have to sit and read through the tax rules yourself, understand them. Then you will have to figure out what is the most tax efficient option for you. Other than that, everything else, all planning, all other aspects of planning, investment, inflation, everything is the same. The only difference is, like I said, if you want to stay there, the inflation will be what is there, and what is the inflation here if you are coming back here. So that's the only major difference. And the other aspect is that if you're staying in a country like US, Europe, or things like that, or even Singapore, you'll have multiple uh, options to do robo advisory. You'll have options to do international diversification, ETFs, commodities, whatever. You can invest in all of those, but you'll have to take some. Do a lot more digging, because if you may be taken for a ride if you are not careful. You may be taken for a ride here as well as there, because everybody assumes NRI have money, and they assume they can charge them higher fees, they can take them for a ride. So you'll have to be very, very careful. The same rules like relationship managers, mis-selling products, those kind of problems will always be there here too. So here as well as there. So you'll have to be aware of that. But first and foremost, please be aware of the tax rules. Please recognize, stop asking people, I'm an NRI, tell me investment options. That's an incomplete question. You'll have to specify where you are from, and that person should know the tax rule. I don't know what is the tax rule in Singapore. I don't know. I don't need to know. I am no. So don't waste your time asking people like me. It's better for you to consult a chartered accountant who's a very NRI specific practice. There are financial advisors also like that, or some of the people in the SEBI registered list of fee only planners in my list also handle NRIs, but they will have to be proficient in the tax rules. So you have to make sure of that, and once you do that, you can start your journey. But before that, so before you even start investing, you must be careful, otherwise you'll simply be bleeding too much money in tax. You'll have to be careful about what you declare and what you don't declare, and you don't want to get into trouble with a taxman there. So I know of stories where many people don't bother to declare their fixed deposits in India, and that could be dangerous in a connected world like the one we live in today. So that's what I wanted to say. Catch you later. Bye bye.